Okay, so into this lesson, we're going to go through price action and the key concepts that we're going to be using for trading. First of all, let's go through what you learned from lesson 2. So what did you learn?
Yeah, well, I learned a bit about candlesticks and fair value gaps and reading price action a little bit, but not that much. Also how like price moves, like from liquidity to fair value gap and stuff like that. Yeah, and learned a bit about time frames, about how like you check the higher time frame for context and use it in your lower time frame for your trading. And yeah, something like that.
Okay, very nice. We're going to go into deeper understanding of these concepts now in this lesson. Was there anything that confused you, or do you have any questions?
My three questions from last lesson
Oh yeah, you sent them to me.
is number one, what does it mean when price returns to a fair value gap, and how can that help you plan a trade?
Okay, so let's go through that real quick. As you can see here, so they basically, let's say here, I'm in the 4-hour time frame. Right here is a fair value gap, right?
Yeah.
So let's write this fair value gap. It's a 4-hour fair value gap. Basically, when price returns here, you want to see how it reacts. So on the 15-minute, you basically can see, obviously the time matters as well. We're going to go through that, but this is just to show you. Once price returns here, from the 4-hour fair value gap, if you tap into a 4-hour, you look for a 15-minute confirmation. If you go into a daily fair value gap, let's say this is a daily, you go into the 1 hour to confirm the fair value gap. So for example, in here, you go in, you open the 15-minute, and you see, for example, in this area or this area as well, but this would have been outside your time zone here at 9:30 when the market opens. You see, we've tapped into it. We created a fair value gap from it. So from the 4-hour fair value gap, we created a 15-minute fair value gap. Do you see right here?
Yeah.
And then another one right here as well. So these two fair value gaps can be, you can use them for further confirmation. So from the 4-hour, we go into the 15-minute. And then in the 15-minute, we make fair value gaps. You can either enter the trade as soon as the fair value gap is created, put stops here, and target this high, but this will not have given you enough risk to reward, obviously. You target the context high. It's more, we'll go into these concepts a bit deeper later on. And then now from the 15-minute, we have 15-minute fair value gaps created, which are in the correct context of the 4-hour, the higher time frame. You can go into the 1-minute. And then you go into the 1-minute, you see we've tapped into here, and you wait for a 1-minute confirmation, which is simply a 1-minute fair value gap. So for example, in here, you take a trade. This example would have been a loss right here, as you can see.
Yeah.
And then you just simply wait until you get a second confirmation maybe, and then you take another trade in here, because we're entering on the 1-minute or the 5-minute mainly. That's mainly what we're going to be using. And then you enter right here, you take profit in here. This is simply put. Do you see?
Yeah.
So we go from the 4-hour. Where are we? Yeah, we go from the 4-hour, the higher time frame, to the 15-minute, the middle time frame, if that's what you want to call it. And then from the middle time frame, you go to the lower time frame for execution. And then here you execute. So that's how we use it.
Yeah. That also answers my second question, which was how can spotting FVGs on higher time frames help you make better entries on lower time frames? Yeah, that answers that question as well.
Perfect. Any other questions?
Yeah, my third and final question was, what does it mean when the market is in consolidation, and why should traders pay attention to that?
Okay, so basically, consolidation simply means that price is moving just like this. It's not making any moves, or maybe the moves are slower. So for example, it moves up, but it's like this. This is another consolidation, or it moves like this. Very slow downward movement, back and forth. And simply, you have to be aware of it. I mean, that's really it. You have to be aware of it and not execute during consolidations, because usually, let's say you tap into the higher time frame key level, okay, you go into it, and then you start consolidating. And even if you get a 1-minute fair value gap, this 1-minute fair value gap is going to fail, and then you're going to continue consolidating. Maybe you get another one, and then it's going to fail again. You understand?
Yeah.
So this, you will learn how to spot these. Obviously, once you get some experience, and once you see them, you should not really trade, because it's not wise to trade the price action, because you'll just continue to take loss after loss, and then maybe finally one works, but you've already taken like 5 losses. Do you see?
Yeah. So you should wait for a break of structure.
Basically, yeah, pretty much. Not necessarily a break of structure, just some more intention behind the moves or some more volume. Yeah.
Yeah.
That was all your questions, right?
Was it?
Yeah.
Yeah.
So let's move into how the market moves. So the two main price behaviors are liquidity to fair value gap to continuation. So basically, price grabs liquidity, stops above a high or a low, for example, then pulls back into a fair value gap to rebalance, then continues in the original direction. So in here, for example, we went up, we took liquidity, we made a fair value gap, we went down to the fair value gap, and then we continued. Do you see? So this is spotted on the higher time frame, usually, and then you use it to spot the same thing or similar thing in the lower time frame to execute a trade. This is the first price behavior. The second price behavior is basically this. You will see a lot in consolidations as well. But if you see on the higher time frame, you can kind of use it to your advantage. So liquidity, we go from one side of liquidity to the opposite liquidity.
Yeah.
So right here, we went up. First we went up, then we went back down to the other side of liquidity, and we continued. We grabbed more liquidity in here, and we went right back up, grabbed some more liquidity. So these, you can use them. It's a bit harder to use them because you have a fair value gap. So you don't want to really trade against it. You have to also it comes with experience, how to spot these. So yeah, simply put, price is either seeking liquidity or offering fair value before the next move. That's really it. And when you see this happening in front of your eyes, that's when you can capitalize on it. Sometimes you will not be able to see it. Sometimes it will not be clear. Then you don't want to trade. You simply want to wait until you can see it and it becomes clear. That also comes with experience. Now for the second concept is displacement versus manipulation. So the displacement is simply the real institutional move, you can call it. It's a strong, impulsive price move that breaks structure. It indicates strength and often leaves behind a fair value gap. That's again where we can use fair value gaps to our advantage. That's the first move, and it's shown in this picture, for example. We displaced through this high with intention, with strength, and we left a fair value gap. And then when the price comes back into this fair value gap, it's very high probability that it will continue to go up. You understand?
Yeah.
Now for the second concept is manipulation. It's basically a trap or a fake out. So it will many times in your trading, it will look like a displacement, but it's not really a displacement. So for example, in here, it's a short-term sharp move designed to grab liquidity. That's simply what it is. So you should not be chasing them. For example, in here, we get price comes down here. We don't leave a fair value gap behind in the higher time frame. We just grab liquidity, just manipulation here, and then we go to the opposite side and we displace. Usually what you will see is before a displacement, you will have manipulation. So you want to spot the manipulation, and then once you get the displacement, which is your confirmation, you can take a trade. And it's very, very important to spot these. Very important. And again, this also comes with experience.
Yeah.
So yeah, now moving into the next concept, fair value gaps. We've already went through this a bit. Now we're going to go through a bit deeper. It's very simple. It's basically a fair value gap is a price imbalance left when price moves too quickly in one direction, skipping over orders. So that is basically the theory part of it. Fair value gap, it basically leaves a candle. It leaves a gap between candle's first high and the third candle's low. So this is in a bullish move. And this is in a bearish move, the exact opposite. And the middle candle is where the fair value gap is. So it just moves too fast, leaving a gap. Right here, you can see a bearish fair value gap. This is the first candle. Second candle moves very quickly. And then the third candle. Do you see?
Yeah.
And yeah, it's a gap between the wicks of the first and the third. Same thing here, but in a bullish example. Exact same thing, but just reversed. So this is the first candle, second candle, and third candle. Very simple stuff. And you already know how to use them now, since I've showed you. So we don't really have to go through that again. Liquidity, you've already gone through this. This is more in depth. So it's basically refers to an area in the market where large volumes of pending orders are resting, usually stop losses or breakout entries. Common liquidity zones are above equal highs, below equal lows, trend lines or patterns, consolidation ranges, or high impact news. So basically the high impact news often sweeps liquidity, but also it can leave liquidity. But this is like very, very, very specific type of liquidity it leaves behind, which you can use to target. So right here, you can see these are lows right here, lows and highs, liquidity in form of lows and highs. Here's some sort of liquidity in form of a trend line, another low, another high. Very simple. And yeah, you can use them in a similar fashion, just like fair value gaps. So you use them, you wait for price to get there, you see how it reacts, if it gives a confirmation or not, or if we displaced through them, like here in this example.
Yeah.
So now into the last thing. It's basically time frame alignment and top-down analysis. I've already showed you to answer the first question you asked me. It's basically the same thing. So we use the higher time frame to stay in sync and in the context of the market direction. So you need to analyze multiple time frames, starting from the top and then going down to your lower time frame, to the entry chart. So a pro tip is basically the higher time frame rules. So if you have a daily fair value gap, okay, and a 1 minute fair value gap, which one is the one that's gonna like be more important?
I think the daily.
Exactly, because the higher time frame rules. So
Yeah.
these concepts can also be used. So always when you see, for example, let's see here, let's find an example. So right here we have a daily fair value gap.
Yeah.
Daily fair value gap. And then you go into your 1 hour. And the 1 hour leaves behind the fair value gap. We go down into it with the fair value gap. Okay? This is the 1 hour.
Yeah.
So now if you're trading in here, let's say you're trading on the 5 minute, which one is going to be more important?
The daily one on the bottom.
Exactly. So yeah, you tap into it. If you tap into the daily fair value gap and you leave behind that 1 hour fair value gap, the 1 hour can be used as resistance. Like it will, the price is like, it will, let's say you take a long here. And this is going to be a problem of an area of problem for you, because the price will still react from it, but it's not as important as the daily. And you can see, for example, in this example, the daily obviously continued the market movement upwards. So simply how to break it down, I'm going to show you live examples. I've already shown you. So directional bias. So you go into your high time frame for directional bias. You spot daily and 4 hour key levels or fair value gaps. Structure key high and lows, fair value gaps, and liquidity. So you start with the daily and 4 hour, for example. Then you move into your 1 hour and 15 minute. You look for similar stuff. So everything you use is like it has to be used in the context above it. So when you go into your 1 hour and 15 minute, it has to be in the context of the daily and 4 hour, just like I showed you before with the fair value gaps. And same thing when you go into the 5 minute and 1 minute, it has to be used within the context of the 1 hour and 15 minute. Do you see how we use it?
Yeah.
So yeah, again, this simply repeats the same thing. Higher time frame bias is price bullish, bearish, or ranging. Higher time frame liquidity, where are clean highs and lows or imbalances. Setup zones, where could price reverse or react from, and lower time frame entry. You wait for your confirmation based on the key levels above and the higher time frame zones, and that's really it. So for your homework, this is going to be more of a practical homework. I want you to find 3 clean examples on TradingView of fair value gaps, equal highs and lows, so liquidity zones, displacement above highs and lows, manipulation of highs and lows, and consolidations. Okay? So I want you to find them and then you screenshot them on TradingView. So basically you press on this, you can either copy link or copy image, and it will copy the screen in front of you. That's the first homework. Then I want you to train your eyes. So basically you're going to go back in time and annotate these concepts that we've went through on TradingView. Okay? So I'm going to show you right now. Let's go into the daily. Let's go here. Let's remove everything here. You simply want to go back here from where you are right now. You want to go back. Oh, I see a daily fair value gap in here. Okay. And then maybe you want to see how it reacts to it. Or maybe here I can see some sort of trendline liquidity in here. Okay. Here, liquidity. Here I see some lows. And this low, for example, came into the fair value gap, the daily fair value gap. And then you want to continue move backwards. Just annotate these things. I would recommend maybe the 4 hour, because there's more shit going on in the 4 hour than the daily.
Yeah.
And also, I want you to try to use these concepts and place 3 demo trades throughout the week, either on EURUSD or NASDAQ. So I want you to use the 15 minute for entries, and everything above for the context and key levels. And then again, let's say you take a trade somewhere on your demo trade, and you want to mark it with, for example, the short or the long button, that's this thing right here. You want to mark it, and then once it hits your stop loss or take profit, I want you to note down, for example, which key levels used. So key levels used, higher time frame key levels used, and the entry confirmation. Okay?
Yeah.
And once it hits take profit or stop loss, I want you to take a screenshot of both the notes and the trade itself.
Yeah.
And like always, prepare 3 new questions or confusions for next session.
Yep.
Yep, that's about it.
Yes, sir.